So the debasement trade, we talked about we're creating excess money to service the debt. That comes with a cost. What is that cost? It's like people don't really see it. They don't feel it. You don't know what it is. What it is you are lowering the purchasing power of fiat versus scarce assets. So $1 today buys you $1 million today, buys you less of the S&P 500 every year because the debasement of the fiat currency. Real estate, gold, crypto, art, classic cars, anything that is scarce value holds value. This is exactly the same that happened for the Venezuelan stock market. In Bolivar terms, it was up 1,000,000% or whatever stupid number it was. When you look at it in dollar terms, it was down 99%. Why? Because they debased the currency to zero. And so that's currency debasement. It's happening about 8% a year on a globalized level because all the major central banks and governments are doing this. So the debasement trade is, if this is the most powerful macro factor of all time, what are the things that offset it? Now, Wall Street is very slow on the uptake. So their first thing is gold. But measurably over time, gold has not meaningfully outperformed debasement because its job is to actually just be stable money and have a stable store of value. So therefore, you're not getting richer owning gold. You're protecting yourself from the debasement. Fine. But if you're going to lock up money in long term by buying an asset, you need to get rewarded for locking your money up. So to be rewarded, you need an asset that outperforms that debasement. So Wall Street's finally caught on to this. It's something I've been writing about extensively, probably have done more research on this than anybody else in the world. And now finally Wall Street's starting to understand the game, which is that scarce assets outperform. Okay. Now, they've all gone to gold, but gold, as I said, is a store of value, but is not a compounder of wealth. But why has gold been outperforming recently? Because there is what we call the global macro investor GMI dominoes, where things affect. There's a chain in terms of time of what works. At the front end of it all is financial conditions. How we measure financial conditions is interest rates, the dollar, and commodity prices. You kind of put a regression analysis around those, you create an index. That leads the ISM by about, which is the business cycle, by about 9 months. So that's the most forward-looking thing that we have. Then we've got global liquidity that lags by about 3 months or 6 months. I can't remember the exact number. And then we've got the business cycle. Assets fall somewhere within those, and then there's some assets that are lagged. But the business cycle is the main driver of assets in cyclical basis. On a secular basis, it's debasement, and financial conditions lead all of that. What we found is that gold has shifted its correlation from being about real interest rates to now being about financial conditions. So think of gold leading Bitcoin by 6 months. That's the work that we've done, that we think it now actually leads, because Bitcoin is liquidity. That's the key driver. Gold is being driven by this future thing, which is financial conditions. So they're all part of the same thing, but just different phasing.